17 states are quietly taxing the money your parents leave you, and the families who get hit the hardest are not the wealthy ones with accountants and attorneys. They are the middle-class families who did everything right, saved everything they had, and assumed that what they built could pass to their children without the government taking another cut. I am going to show you exactly which 17 states do this, how the tax is calculated, why it catches families completely off guard, and what can still be done to protect what your parents built before it is too late. Most Americans know that the federal government has an estate tax. What they do not know is that the federal estate tax exemption in 2026 is $13.6 million per individual. That means the vast majority of American families will never owe a single dollar in federal estate tax. The federal threshold is high enough that it does not touch ordinary working families. The 17 states do not follow that exemption. They have their own death taxes with their own thresholds, and those thresholds are dramatically lower than the federal level. In some states, the tax kicks in on estates worth as little as $1 million. In a country where a modest home in a major metro area can clear that number on its own, $1 million is not a wealthy estate. It is the house your parents bought 40 years ago that is now worth more than they ever imagined. Before I name the states, I need to explain the difference between two types of death taxes that most people confuse. The first is the estate tax. An estate tax is levied against the total value of someone's estate before any assets are distributed to heirs. The government calculates what the person owned at death, subtracts the exemption amount, and taxes whatever remains above the threshold. The estate pays the tax. The heirs receive what is left after the estate settles the bill. The second is the inheritance tax. An inheritance tax works differently. It is not levied against the estate as a whole. It is levied against the individual who receives the inheritance. Each beneficiary owes a percentage of what they personally receive. The rate often depends on the relationship between the beneficiary and the deceased. Children and spouses typically pay lower rates or qualify for full exemptions. Siblings, nieces, nephews, friends, and unmarried partners often pay the highest rates. 6 states have an inheritance tax. 12 states and the District of Columbia have an estate tax. 2 states have both. When you add up the unique jurisdictions with one or both types of death tax, the total is 17 states plus the District of Columbia that impose some form of state-level death tax that the federal system does not require. Here are the 6 inheritance tax states: Iowa, Kentucky, Maryland, Nebraska, New Jersey, Pennsylvania. Of those 6, Maryland also has a separate estate tax, which means Maryland families can potentially face both taxes on the same assets at the same time. Here are the states with estate taxes only: Connecticut, Hawaii, Illinois, Maine, Massachusetts, Minnesota, New York, Oregon, Rhode Island, Vermont, Washington State, and the District of Columbia. If you or your parents live in any of these states, the federal estate tax exemption does not protect you from the state-level tax. The states set their own rules entirely. Now let me show you what the thresholds actually look like, because this is where the gap between the federal system and the state system becomes visible. Massachusetts taxes estates above $1 million. $1 million. The federal exemption is more than 13 times higher. In the Boston metro area, the median home price exceeded $700,000 in 2025. Add a retirement account, a car, personal property, and a small investment account, and a family that considers itself firmly middle class can cross the Massachusetts threshold without coming close to what anyone would call wealthy. Oregon taxes estates above $1 million as well. The top rate in Oregon reaches 16% on assets above $9.5 million. But families at $1 million in taxable estate are paying rates that start at 10% on the amount above the exemption. On a $200,000 excess above the threshold, that is $20,000 owed to Oregon before the family sees a cent. Minnesota taxes estates above $3 million, higher than Massachusetts and Oregon, but still $3 million in a state where agricultural land has appreciated significantly and family farms routinely cross that threshold. Farm families in Minnesota have lost operational land to estate tax bills because the land is worth millions but generates modest annual income. The heirs cannot pay the tax without selling a portion of the farm. Illinois taxes estates above $4 million. New York taxes estates above $6.94 million, but New York has a cliff provision that creates an unusual trap. If the estate exceeds the New York exemption by more than 5%, the entire exemption is eliminated, not phased out. Eliminated. An estate worth $7.3 million in New York owes tax on the entire 7.3 million, not just on the amount above the exemption. Families that fall into New York's cliff zone effectively pay a higher marginal rate than families with significantly larger estates. Connecticut has an exemption of 13 million, which aligns closer to the federal level and therefore catches fewer estates. Washington state taxes estates above 2.2 million. Maine and Rhode Island are near 3 million. Vermont is around 5 million. Now let me show you how the inheritance tax works with specific numbers, because the inheritance tax is more confusing and often more unexpected than the estate tax. In Pennsylvania, there is no exemption for most beneficiaries. If a parent dies and leaves assets to an adult child, the adult child owes 4.5% of everything they receive. If you inherit $200,000 in Pennsylvania, you owe $9,000 in inheritance tax due within 9 months of the death. If you inherit from a sibling in Pennsylvania, the rate is 12%. If you inherit from someone who was not a direct family member, the rate is 15%. Pennsylvania does exempt assets passing between spouses. It also exempts assets passing to minor children. But adult children pay 4.5% on everything, every time, regardless of the total estate value and regardless of whether the federal exemption was ever in play. A retired teacher in Pittsburgh passes away. She owned her home worth $180,000. She had an IRA worth $90,000. She had a savings account with $30,000. Total estate, $300,000. Her adult daughter inherits the home and the financial accounts. The daughter owes 4.5% of $300,000. That is $13,500, due within 9 months. The daughter may not have $13,500 in liquid cash. The IRA distributions she receives are also subject to income tax in addition to the inheritance tax. She is paying 2 separate tax obligations triggered by the same death. In New Jersey, inheritance tax rates for siblings and other nonlineal heirs reach 16%. New Jersey does exempt assets to spouses and direct lineal descendants, but aunts, uncles, nieces, nephews, and unmarried partners pay rates that can reach 16% on inheritances above $150,000. In Nebraska, remote relatives and unrelated beneficiaries pay up to 18%. In Kentucky, rates for siblings reach 16%. For more distant relatives, they can reach 16% as well, depending on the amount. Here is what catches families completely off guard in inheritance tax states. The tax is owed by the beneficiary, not by the estate, which means the estate can fully settle, assets can fully transfer, and only then does the beneficiary realize they owe a tax bill. If a parent left a house directly to a child, and the child thought inheriting the house was straightforward, the Pennsylvania child now owes 4.5% of the appraised home value in cash, due within 9 months on an asset that is illiquid by nature. Some families sell the inherited home specifically to pay the inheritance tax. They had no intention of selling. They wanted to keep the property, but the tax is due in cash and the asset they inherited cannot produce cash without being sold. The estate tax creates a different but equally serious problem. Estate taxes are assessed against the estate before distribution, but the estate's assets may not be liquid. A family that inherits a farm, a small business, or a primary residence in a high exemption state may face an estate tax bill that cannot be paid without liquidating the very asset the family wanted to keep. The IRS has provisions that allow installment payments for estate tax on closely held businesses and farms at the federal level. Some states have similar provisions, but the family still faces the decision of whether to pursue installment payments, take out loans against the inherited assets, or sell portions of what was inherited. A farming family in Oregon with 300 acres has an estate worth approximately $3 million at current agricultural land prices. The federal exemption covers the entire estate. Oregon taxes everything above $1 million. $2 million is subject to Oregon estate tax at rates reaching 16% on the highest amount. The tax bill on that $2 million in excess can reach $240,000. The farm generates enough cash annually to operate, but not to pay a $240,000 tax bill in one lump sum. The family is forced to negotiate a payment plan, take a loan against the land, or sell acreage. The farm that has been in the family for 3 generations gets smaller because Oregon has an estate tax, and because land values have risen far faster than estate tax exemptions. This is the mechanism that destroys family wealth across 17 states. Not fraud, not bad decisions. Just the gap between rising asset values and exemption thresholds that states have not adjusted to match. Several of these states have not changed their exemption amounts in years. Massachusetts has been at $1 million since 2003. The median home price in Massachusetts in 2003 was approximately $300,000. Today, it exceeds $600,000. The exemption has stayed flat while assets doubled. That means twice as many Massachusetts families now fall inside the taxable estate zone as did when the threshold was set. Now I need to address the strategies that actually work before I close. The first and most effective strategy is lifetime gifting. Federal law allows any individual to give up to $18,000 per year to any recipient without triggering gift tax and without reducing the federal estate tax exemption. A parent with 2 children can give $36,000 per year total without any tax consequence. Over 10 years, that removes $360,000 from the taxable estate. In a state like Massachusetts, where the threshold is $1 million, systematic gifting over a decade can reduce an estate below the state threshold entirely. The annual gift exclusion does not prevent state estate tax on its own, but combined with other planning, it is one of the cleanest and most accessible tools available. The second strategy is irrevocable life insurance trusts. A life insurance policy owned inside an irrevocable trust does not count as part of the taxable estate. The death benefit pays to the trust outside the estate, and the trustee can use those funds to pay estate taxes, reimburse heirs, or purchase illiquid assets from the estate to provide cash for tax obligations. Families that know they will face estate tax often structure life insurance to cover the anticipated bill so heirs do not have to liquidate the inherited assets to pay. The third strategy specific to inheritance tax states is beneficiary designation review. Retirement accounts, life insurance policies, and annuities pass by beneficiary designation outside of probate. In some inheritance tax states, the tax treatment of assets transferred by beneficiary designation differs from assets transferred through the estate. In Pennsylvania, for example, retirement account distributions from an IRA are subject to federal income tax, but may not be subject to Pennsylvania inheritance tax in all circumstances depending on how the account is structured and the beneficiary relationship. Families that understand the distinction between probate assets and non-probate assets in their specific state can sometimes reduce the inheritance tax exposure by structuring transfers carefully. The fourth strategy is simply moving. It is available and legal. 7 states have no income tax. Several states have no estate or inheritance tax. If your parents are still alive and are open to relocation, moving from Pennsylvania or New Jersey to Florida eliminates the inheritance tax entirely. Florida has neither a state income tax nor a state estate or inheritance tax. The same is true of Texas, Nevada, and several other states. For families with significant assets, the tax savings from relocating can dwarf the cost of moving. Here is the hardest truth in all of this. The 17 states that impose these taxes are not hiding them. The laws are public record. The rates are posted on state revenue department websites. But the families who pay the most in state death taxes are overwhelmingly the ones who did not know the tax existed until after the death occurred. At that point, the planning window has closed. The assets are already in the estate. The exemptions are already exceeded. The strategies that would have helped require years of lead time. A person who learned about Massachusetts estate tax 5 years before their death can systematically gift assets below the threshold, restructure ownership of the home, and fund a life insurance trust. A person whose family discovers the Massachusetts estate tax when they open probate after the death has none of those options. The estate is what it is. The tax is what it is. The check has to be written. If your parents own a home, a retirement account, a small business, or any meaningful assets in one of these 17 states, the conversation needs to happen now, not at the estate planning attorney's office after the funeral. Now, while gifting can run, while trusts can be funded, while beneficiary designations can be adjusted, while the options are still open. Find an estate planning attorney who specifically practices in your state and ask 2 questions. Does this state have an estate tax, an inheritance tax, or both? And what does our family's current asset picture look like against the state exemption? Those 2 questions answered today are worth more than any financial decision your family makes this year. The 17 states set the rules. They did not notify you. They are not going to.